If you are sitting on more than 1,000 ounces of silver or gold right now, you need to stop whatever you are doing and pay close attention to what I am about to share with you, because there is a structural trap being set in the commodity markets right now, and most retail stackers and investors have absolutely no idea it even exists. I am not talking about the usual doom and gloom narrative you hear from every precious metals channel on YouTube. I am talking about a very specific, very real, very documented mechanism inside the COMEX future system that directly threatens people who hold significant physical positions, and if you do not understand how it works, you could end up watching the price of your metal do something that seems completely irrational while the insiders on the other side of the trade walk away with your money. So stay with me through this entire video, because I am going to walk you through exactly how the COMEX system functions, why it creates a trap for large holders, what the warning signs look like right now, and most importantly, what you can actually do to protect yourself and your wealth. This is not financial advice, this is financial education, and there is a massive difference between the two. What I am giving you today is the map that the mainstream financial media refuses to draw for you. Let us start at the very beginning, because even if you have been stacking silver or gold for years, there is a good chance that your understanding of COMEX is incomplete. And that incomplete understanding is exactly what makes the trap so effective. COMEX stands for the Commodity Exchange, and it is a division of the CME Group, which is the Chicago Mercantile Exchange. COMEX is the world's largest marketplace for trading gold and silver futures contracts. Now here is the critical thing you need to understand. When you buy a futures contract on COMEX, you are not buying gold or silver, you are buying a promise. A contract, a piece of paper that says someone will deliver gold or silver to you at a specified price on a specified date in the future. The vast majority of these contracts are never actually settled with physical metal. They are cash settled, meaning the positions are closed before the delivery date, and the difference in price is paid in dollars. Only a tiny fraction of open interest on COMEX ever results in actual physical delivery. We are talking about historically somewhere between 1 and 3% of total contracts. That is an extraordinary fact that most people in the general public have never heard. The world's largest gold and silver exchange operates almost entirely on paper promises with almost no actual metal changing hands. Now, why does this matter? It matters because the price of gold and silver that the entire world references, the price that is printed in the newspaper, the price that your coin dealer quotes you, the price that mining companies use to value their reserves, the price that central banks use in their accounting, all of it is determined by this market where less than 2% of contracts ever see physical delivery. The tail is wagging the dog on a massive scale. The paper price is setting the physical price, even though the paper market is hundreds of times larger than the physical market. Some estimates suggest that for every ounce of physical gold that exists in the world, there are between 100 and 300 paper claims on that same ounce depending on how you count it. For silver, the numbers are even more extreme because silver has the dual dynamic of being both a monetary metal and an industrial metal with real supply constraints. This disconnect between paper and physical is not an accident. It is a feature of the system, not a bug, and it has been deliberately maintained because it serves the interests of the banks and financial institutions that dominate trading on COMEX. Here is where it gets really interesting and where the trap starts to become visible. The players who dominate COMEX trading are called commercials. These are the large banks, the bullion dealers, the mining companies, and the financial institutions that trade futures professionally. On the other side of the trade, you have what are called speculators, which include hedge funds, commodity trading advisors, and retail traders. The Commodity Futures Trading Commission, which is the regulator that oversees COMEX, publishes a weekly report called the Commitments of Traders Report, or the COT report. This report breaks down the positioning of these different categories of traders, and it is one of the most revealing documents in all of finance. If you know how to read it, it tells you almost exactly what the banks are planning to do with prices. The commercials, the banks and dealers, are almost always net short in gold and silver. This means they have sold more futures contracts than they have bought. They have effectively bet that prices will go down, or at least that they can profit from the structure of the futures curve even if prices go up. The speculators, the hedge funds, and retail traders are almost always net long. They have bought more contracts than they have sold. They are betting prices will go up. This setup repeats itself over and over again in what traders call a cycle. When speculator longs get very large and commercial shorts get very large, the stage is set for a washout. The commercials, who have massive balance sheets and effectively unlimited access to credit, begin engineering price drops to trigger stop losses on the speculator long positions. Stop losses are automatic sell orders that traders set to limit their downside. When prices drop sharply, these stop losses trigger, forcing speculators to sell their long positions. As speculators sell, prices drop further, triggering more stop losses, which causes more selling in a self-reinforcing cascade. The commercials, meanwhile, have been short the whole time, so they are profiting as prices fall. At the bottom of this waterfall sell-off, the commercials buy back their short positions at a profit and the speculators have been wiped out. Then the cycle begins again. Speculators enter new long positions as prices stabilize and begin to recover. The commercials go short again, and eventually the same washout happens again. This cycle has repeated dozens of times over the past 40 years, and it is so well documented that multiple books have been written about it. Ted Butler spent decades documenting this manipulation in silver specifically, and the evidence he compiled is overwhelming. Now here is where you, as someone who holds over 1,000 ounces of physical metal, need to pay very close attention, because everything I just described is background context for the specific trap that is forming right now in this market environment. The trap is called a short squeeze, but it is not the kind of short squeeze that benefits you. It is the kind that the banks use to trap large physical holders into panic selling at exactly the wrong time. Let me explain how this works. When COMEX registered warehouse stocks of silver or gold get very low, meaning the amount of physical metal that is actually available for delivery declines significantly, you would think this would drive prices up dramatically because supply is tight. And in a purely physical market, it would. But in the COMEX paper market, what actually happens is more complicated and more dangerous for the uninformed holder. When registered stocks decline, the banks and commercials know that if too many people demand physical delivery, the system could break. So they do something counterintuitive. They actually increase their paper short selling to drive prices down sharply, which accomplishes two things at once. First, it discourages new buyers from entering the market because the falling price looks like a bear trend. Second, and this is the critical part, it creates financial pressure on large physical holders who may have borrowed money against their metal, or who have paper positions in addition to their physical, or who are simply psychologically broken by watching the price of something they own decline day after day. The banks want to force these large holders to sell or to stop demanding delivery. They want to relieve the pressure on the physical supply without actually having to produce more metal. It is a psychological and financial warfare campaign conducted through the futures markets, and it works extremely well on anyone who does not understand the game being played. The trap for you specifically as a holder of over 1,000 ounces is multi-dimensional. First, there is the paper loss problem. When you are sitting on a position worth hundreds of thousands of dollars or more in physical metal, and the paper price drops 20 or 30% in a short period, the psychological pressure is immense. Most people cannot handle it. They start to doubt their thesis. They start wondering if they made a mistake. They start calculating how much money they are losing on paper. And some of them sell. They sell exactly when they should be buying more. This is the emotional trap, and it gets more powerful the larger your position is, paradoxically, because the absolute dollar figure of the paper loss is larger. Second, there is the leverage trap. If you have borrowed against your metal, or if you hold ETF positions like SLV or GLD in addition to your physical stack, a sharp price decline can trigger margin calls or forced selling in the paper positions that then creates additional selling pressure in the market generally. Third, there is the insurance trap. Large metal holders sometimes have their metal insured, and insurance costs can spike when volatility rises, creating additional carrying costs that push some holders toward liquidation. Fourth, there is the storage trap. Large positions require serious storage solutions, vault space security, and ongoing fees. When prices are declining and costs remain constant or increase, the math of holding starts to look worse, and the temptation to sell grows. All of these traps converge at the same time because they are all triggered by the same paper price manipulation. And the banks know this. They understand the cost structure, the leverage patterns, the psychological breaking points of large holders better than most large holders understand themselves. They have decades of data, and they have watched this movie play out hundreds of times. You are not the first person to stack 1,000 ounces and feel confident about it. And many of the people who came before you and felt that same confidence ended up selling at the bottom because they got caught in this trap without knowing it existed. So what makes right now particularly dangerous? Why am I making this video at this specific moment? Because several indicators are converging simultaneously that have historically preceded some of the most violent washout events in silver and gold markets. The first indicator is COMEX registered stocks. Registered stocks are the metal that has been earmarked for delivery on COMEX. They are the metal that is actually available to fulfill futures contracts if buyers demand physical delivery. Over the past several years, registered silver stocks on COMEX have declined dramatically from their peak. At various points, the amount of silver in registered vaults has hit multi-decade lows. When registered stocks are low and open interest in futures is high, you have a situation where there are many more paper claims on each ounce of available metal. This is a structurally fragile situation. The system can handle it as long as people do not actually demand delivery in large numbers, but if there is any kind of stress event that causes a delivery rush, the fragility becomes visible very quickly. The second indicator is the lease rate environment. Gold and silver lease rates are the interest rates charged when metal is borrowed and lent in the professional market. When lease rates spike, it means that someone needs physical metal urgently and is willing to pay a premium to borrow it. Lease rate spikes often precede violent price action, and they are a signal that the physical market is experiencing genuine stress that the paper price is not yet reflecting. Watching lease rates is one of the most sophisticated ways to understand what is actually happening in the real metal market beneath the surface of the COMEX paper price. The third indicator is the behavior of large institutional buyers, particularly central banks and sovereign wealth funds. Central bank gold buying has been at multi-decade highs in recent years. Countries like China, India, Poland, Turkey, and many others have been aggressively adding to their gold reserves in a way that has not been seen since the breakdown of Bretton Woods in the early 1970s. This is not random. Central banks understand geopolitics and monetary systems better than almost anyone, and when they are buying gold at this pace, they are making a statement about their confidence in the existing dollar-based monetary order. The fact that they are buying physical gold, not futures contracts or ETFs, but actual allocated gold bars, is extremely significant. It means the demand for real physical metal is growing from the most sophisticated buyers in the world at the same time that COMEX registered stocks are declining. The fourth indicator is the growing divergence between physical and paper premiums. In a healthy, well-functioning market, the price you pay for a physical silver coin or gold bar should be very close to the COMEX futures price, with just a small premium to cover minting and dealer margins. Historically, premiums on silver coins were $2 to $3 over spot. Premiums on gold bars were $10 to $30 over spot. In recent years, premiums have been dramatically higher and more volatile. At various stress points, silver coin premiums have gone to $8, $10, even $15 over spot, representing a 30 to 50% premium above the official paper price. This tells you something very important. The physical market and the paper market are increasingly diverging. Real buyers who want real metal are having to pay dramatically more than the official price. This is the market trying to tell you that the paper price is not the real price. The real price is whatever people are actually willing to pay to hold a physical ounce in their hand, and that price is consistently and increasingly above what the COMEX paper market says it should be. Now, let me talk about something that most precious metals commentators avoid discussing because it challenges the comfortable narrative that simply holding physical metal makes you safe. The dangerous assumption that many large stackers make is that because their metal is physical, because they actually have it in their possession or in an allocated vault, they are completely immune to the COMEX trap. And in the very long run, in the final accounting, when the system eventually breaks in paper and physical prices diverge permanently, that assumption may be correct. But in the medium term, in the months and years between now and that eventual reckoning, the COMEX paper price still dominates your financial reality in ways that you cannot escape by simply owning physical metal. Your insurance premiums are based on the COMEX price. Your borrowing capacity against the metal is based on the COMEX price. Your ability to exit the position at any particular time is constrained by the COMEX price, because that is what dealers use as their reference point. If you ever need liquidity from your metal position for any reason, the COMEX price is what determines what you get. And if the banks have engineered a sharp paper price decline at exactly the moment you need liquidity, you are going to feel that trap very acutely, even though your physical metal is sitting safely in your vault. This is why understanding the trap is not just academic. It is practically important for managing a large physical position responsibly. You need to know that the price on your screen is not a true reflection of physical supply and demand. You need to know that it can be moved violently in any direction by paper market actors who have far more capital and far more sophisticated tools than you do. And you need to structure your position in a way that allows you to survive and even benefit from these manipulated price swings rather than being destroyed by them. Let me talk about the specific mechanics of how a COMEX engineered sell-off actually happens in practice, because understanding the machinery gives you the ability to recognize it when it is starting. The first phase is what traders call the setup phase. During this phase, the paper price has been rising for an extended period, often driven by macro news like inflation data, geopolitical stress, or central bank policy changes. Speculative long positions on COMEX have been building steadily, meaning more and more hedge funds and retail traders have been buying futures contracts. The commercial short position, meaning the banks and dealers, has been growing commensurately as they sell into the speculator buying. At some point, the speculative long position gets very extended. The COT report shows that managed money longs, which is the hedge fund category, are near historical highs. The commercial short position is near historical highs. When you see this configuration in the COT data, you are looking at a fully loaded gun. The commercials are underwater on their short positions if prices keep rising, but they have the ammunition to reverse the trend, and the speculators are extremely vulnerable to a sharp reversal. The second phase is the trigger phase. The commercials need something to spark the selling, something that gives the price decline an air of legitimacy, a news event that the financial media can point to as the reason for the move. This can be an unexpectedly hawkish Federal Reserve statement, a strong employment report that reduces expectations for rate cuts, a sudden strengthening in the dollar index, a geopolitical development that gets resolved unexpectedly, or simply a technical break of an important chart level that triggers algorithmic selling. The actual trigger almost does not matter. What matters is that prices drop sharply enough and fast enough to start triggering stop losses. The third phase is the cascade phase. Once stop losses start getting hit, the selling becomes self-reinforcing. Each stop loss trigger causes more selling, which causes more price decline, which triggers more stop losses. High-frequency trading algorithms accelerate this process, recognizing the downward momentum and adding to it. The financial media begins writing stories about why gold and silver are falling, finding fundamental justifications for what is actually a technically driven paper market event. Retail investors and smaller holders see the news coverage and the falling price and get scared. Some of them sell. The cascade deepens. At some point, prices move through critical support levels that trigger even larger algorithmic selling programs, and the sell-off can be absolutely vicious in a matter of hours or days. Historical examples include the April 2013 gold and silver smash, where gold dropped nearly $200 in 2 days, the December 2015 sell-off, the March 2020 COVID crash, where silver fell to under $12, and several others. The fourth phase is the accumulation phase. This is where the banks cover their shorts. Having driven prices down 20 or 30%, they begin quietly buying back their short positions at a profit and establishing new long positions. They do this slowly, under the radar, in ways that do not create obvious upward price pressure. The COT data, with its weekly delay, will eventually show you that the commercial short position has declined dramatically and that commercial long positions have increased. The speculative long position will be decimated because most of the hedge funds and retail traders got stopped out during the cascade phase. This reconfigured positioning sets the stage for the next move higher, and the cycle begins again. Now here is the most important question. What should you do with this knowledge? If you are holding over 1,000 ounces of physical metal, you have made a significant commitment to a particular view about monetary policy, currency debasement, and the long-term value of precious metals relative to fiat money. That fundamental thesis may be completely correct, and I would argue that the macro environment makes it more compelling today than it has been at any point in my lifetime. But being right about the fundamental thesis does not protect you from the paper market trap in the short to medium term. You can be absolutely correct about where prices are going eventually and still suffer enormously if you are not positioned correctly for the journey there. The first thing you need to do is honestly assess your financial resilience. Ask yourself this question: if silver dropped from its current price to $8 tomorrow, or if gold dropped from its current price to $1,200, what would happen to your life? Could you service your debts? Could you meet your obligations? Would you be forced to sell metal to generate liquidity? If the answer to any of those questions creates serious financial stress, you are overexposed relative to your financial situation. This is not a criticism. Many people who have been stacking for years have gradually increased their exposure as their conviction grew, and they have not done an honest stress test of what a worst-case paper market scenario would actually mean for their financial life. Do that stress test now, before the trap springs, not after. The second thing you need to do is eliminate any leverage in your precious metals position. If you have borrowed against your metal, if you have margin positions in futures or leveraged ETFs, if you have any debt structure that is collateralized by your metal, or that depends on the metal price staying above a certain level, you need to address that urgently. Leverage is what converts a temporary paper loss into a permanent financial loss. The banks use leverage as the weapon to force large holders to sell at the bottom. If you have no leverage, they cannot force your hand. You can simply wait out any paper market manipulation, no matter how severe or prolonged it becomes. Removing leverage from your position is the single most important defensive step you can take. The third thing you need to do is stop relying on a single custodian or storage solution. This is both a security consideration and a financial one. If all of your metal is in one location, whether that is a home safe, a bank safety deposit box, or a private vault, you have concentration risk. You also have counterparty risk with your storage provider. The ideal structure for a large physical position involves metal in multiple locations, potentially including some in your direct physical possession for liquidity and emergency access, some in a segregated allocated account at a reputable vault with regular independent audits, and potentially some in a different jurisdiction than your country of residence as a geopolitical hedge. None of these suggestions require you to sell any metal. They are about the structure and distribution of what you already own, not the size of your position. The fourth thing you need to do is develop a much more sophisticated understanding of the COT report and how to read it. The Commitments of Traders report is published every Friday by the CFTC, and it covers data as of the previous Tuesday. It is free, it is publicly available, and it is one of the most valuable analytical tools available to precious metals investors. Learning to read the structure of commercial versus speculative positioning will not let you predict prices with certainty, but it will give you a much clearer picture of when the market is structurally vulnerable to a manufactured sell-off and when the coast is relatively clear. There are several excellent analysts who publish regular COT analysis specifically focused on gold and silver, and following their work can be extremely valuable. The fifth thing you need to do is develop a clear written plan for what you will do under various price scenarios. Not a vague intention, but an actual written document that says, if silver drops to X price, I will do Y. If gold drops to X price, I will do Z. Having this plan written down in advance serves two purposes. First, it forces you to think through these scenarios with a clear head before they happen, rather than in the middle of the emotional chaos of a sharp price decline. Second, it gives you something concrete to reference when prices are moving violently and your emotions are telling you to do something irrational. Many large holders have been destroyed not because their fundamental analysis was wrong, but because they did not have a written plan and they made emotional decisions under pressure. Now let me talk about something that is particularly relevant for people who hold over 1,000 ounces and who are thinking seriously about the longer-term picture. There is a growing body of evidence that we are in the early stages of a fundamental restructuring of the global monetary system. This is not conspiracy theory. It is documented in the public statements of central bank officials, in academic papers, published by the Bank for International Settlements, in the policy decisions of major sovereign nations, and in the actual behavior of gold flows around the world. The post-1971 dollar system, where the United States dollar serves as the world's reserve currency, unconstrained by any commodity backing, is under serious and growing stress. The aggressive use of dollar sanctions against Russia following the Ukraine conflict, which resulted in the freezing of approximately $300 billion in Russian sovereign reserves, sent a shockwave through every finance ministry and central bank in the world. The message was clear. Dollar reserves are not truly yours if you are on the wrong side of American foreign policy. The response from many countries, particularly in the global south, has been to reduce dollar reserve holdings and increase gold holdings. This is not speculation. This is documented in official reserve reporting data. China has been adding to its official gold reserves consistently, though most analysts believe that the officially reported numbers significantly understate China's actual gold holdings because China routes much of its gold accumulation through channels that are not included in official reserve reporting. Russia transformed its reserve structure dramatically after Western sanctions in 2014, converting a large portion of its dollar reserves into gold and achieving a situation where gold represents the single largest component of its reserves. The BRICS nations collectively have been discussing alternative settlement mechanisms for international trade that would not rely on the dollar, and gold has been mentioned in various forms as a potential anchor for such a system. None of this means the dollar collapses tomorrow. None of this means gold immediately revalues to $10,000 an ounce. But it does mean that the structural demand for physical gold from the most powerful sovereign buyers in the world is unlikely to reverse, and that the direction of travel for monetary system transformation is toward a more prominent role for gold over time. For silver, the story is different, but equally compelling. Silver is unique among precious metals in that it has essentially irreplaceable industrial applications in several of the most critical technologies of the coming decades. Solar panels require silver. Electric vehicle charging infrastructure requires silver. 5G networks require silver. Medical devices require silver. The electrification of the global economy, which every major government is pursuing as a policy priority, is going to require enormous and growing quantities of silver. At the same time, silver mine production is constrained and is not expected to increase dramatically because most silver is produced as a byproduct of mining other metals like copper, zinc, and lead, and increasing silver production requires those other metals to be economically attractive. The above ground stocks of silver that exist in investment grade form are far smaller than most people realize, and the ratio of paper silver contracts to actual available physical silver has been growing for years. When industrial demand growth collides with investment demand growth in a market where available physical supply is severely constrained, the potential for an explosive price move is real. The question is not whether, but when, and whether you will still be holding your position when it happens, or whether you will have been shaken out by a paper market trap before the move occurs. Let me address one more aspect of the COMEX trap that most people do not discuss because it involves something that feels uncomfortable, which is the role of regulatory capture in allowing this system to persist. The CFTC, the agency that regulates commodity futures markets including COMEX, has been aware of concerns about silver market manipulation for decades. Ted Butler filed detailed complaints with documented evidence of manipulation with the CFTC repeatedly over many years. The agency conducted investigations, those investigations took years, and ultimately concluded without meaningful enforcement action against the large short sellers. The revolving door between Wall Street financial institutions and the CFTC is well documented. Senior figures move between regulatory positions and industry positions in ways that create significant conflicts of interest. This is not a wild accusation. It is documented in public records and has been reported on by mainstream financial journalists. The implication for you as a metals holder is that you should not expect regulatory intervention to protect you from paper market manipulation. The system as currently constituted is designed to allow that manipulation to continue because it serves the interests of the large financial institutions that dominate both the market and, indirectly, the regulatory process. Your protection has to come from your own understanding and your own financial structure, not from a regulator coming to your rescue. There is also the question of what happens when and if the COMEX system actually breaks. Several precious metals analysts have argued for years that eventually the paper market disconnect from physical reality will become untenable, that a point will come where enough large buyers demand actual physical delivery that the system cannot satisfy those demands without a dramatic price revaluation. This event is sometimes called the COMEX default, though that is a somewhat misleading term because the exchange has mechanisms to avoid a formal default, including cash settlement, in lieu of physical delivery and position limits that can be imposed on traders. But even if it is not a formal default, a situation where the exchange is forced to cash settle large delivery demands at above market prices would be effectively a recognition that the paper price has been fraudulently low relative to the real physical price, and it would likely trigger exactly the kind of explosive price move that large holders have been waiting for. The question is whether the exchange and its allies in the large banking community can continue to suppress prices for long enough to drain the inventory and relieve the pressure, or whether physical demand growth outstrips their ability to manage the situation. Historical precedent from the Hunt brothers episode in 1979 and 1980 is instructive, though not in the way most people think. The standard narrative is that the Hunt brothers tried to corner the silver market and were stopped by regulators who changed the rules mid-game. But a closer reading of that history reveals that what actually happened is that the large commercial short sellers exactly the same type of actors who dominate COMEX today, use their influence with the exchange to impose special position limits, specifically targeting the Hunt brothers while exempting their own positions. The rules were changed during the game to protect the establishment shorts from being squeezed. The lesson is not that the Hunts were bad actors who deserved what happened to them. The lesson is that when large physical holders accumulate enough metal to genuinely threaten the paper market structure, the establishment has both the means and the demonstrated willingness to change the rules to protect the paper system. This could happen again, and any serious metals investor needs to have thought through how they would respond to a scenario where the rules of the game are changed in ways that disadvantage physical holders. What gives me long-term confidence despite all of these risks and traps is the fundamental mathematics of the situation. You cannot print gold. You cannot print silver. The supply of these metals is constrained by geology and the economics of mining. The supply of dollars, euros, yen, and every other fiat currency is constrained only by the political will of central banks, and that political will has been demonstrated repeatedly to be essentially unlimited when the choice is between printing money and allowing financial system stress to create recessions. Every major economy in the world has taken on extraordinary debt levels over the past 2 decades. The United States national debt is approaching $40 trillion and growing by trillions annually. The interest payments on that debt are now the largest single line item in the federal budget, larger than defense spending. There is no credible path to reducing that debt burden through genuine fiscal adjustment. The only available exits are inflation, which reduces the real value of the debt, or some form of debt restructuring. Both of these exits benefit gold and silver holders dramatically. The only scenario in which precious metals perform poorly is one of genuine sustained deflation, and in a world where central banks have demonstrated they will do literally anything to prevent deflation, that scenario is the least likely of all the available futures. So the final message I want to leave you with, having walked through all of this, is this. If you own over 1,000 ounces of silver or gold, you have made a smart decision about long-term wealth preservation. The fundamental case for precious metals in the current monetary environment is stronger than it has been in decades. But intelligence and conviction are not the same as strategy, and the COMEX trap can harm even the most intelligent and convicted holder if they have not structured their position correctly. The trap is real. The manipulation is real. The risk of being financially pressured into selling at the worst possible time is real. None of that changes the ultimate destination. What it changes is whether you arrive at that destination with your position intact or whether you get shaken out somewhere along the way. Do your stress test. Remove your leverage. Diversify your storage. Learn to read the QT report. Write your plan before you need it. And when the paper price drops sharply and the financial media is writing stories about why gold and silver are dead, remember everything you learned today and recognize it for what it is. It is the banks setting the trap. And you, because you watched this video and because you understand the game, are not going to step into it. If you found this video valuable, please share it with anyone you know who is holding significant precious metals positions and who might not understand the risks I have described here. This kind of analysis is not available in the mainstream financial media because the mainstream financial media is sponsored by the same banks and financial institutions that benefit from keeping retail investors in the dark. The best thing you can do to protect yourself and to support independent financial education is to share this content with people who need to hear it. Hit that like button because it helps the YouTube algorithm push this video to more people who need to understand these risks. Subscribe to this channel if you want to continue getting analysis like this, because we are going to be watching the COMEX situation very closely in the coming months, and if the indicators I described today continue to develop, I will be back with updates. Leave a comment below telling me how many ounces you are holding, whether you think the COMEX system is sustainable, and what steps you have taken to protect your position from the risks we discussed today. Your comments help me understand what topics to cover in future videos, and they create a community discussion that is valuable for everyone watching. The information asymmetry between large financial institutions and individual investors is the biggest structural disadvantage that ordinary people face in building and preserving wealth. Videos like this exist to narrow that gap, and every share and every comment makes that work more effective. Thank you for watching the full video, and I will see you in the next one.